Hi, and welcome to a Pepperstone video where we will be explaining lots and leverage within the Forex markets. To begin with, I'd like to take a quick look at base currencies and an explanation of those. If we're trading the Great British Pound versus the US dollar, the first currency pair, or the Great British Pound, is what's known as the base currency. Again, if we're trading the Australian versus the US dollar, the Australian dollar would be the base currency. And if we're trading the euro versus the US dollar, the euro will be the base currency. So now that we understand base currencies, let's take a quick look at a lot size or a contract size within the Forex markets. If we're trading one lot in the Forex markets, this will equal 100,000 units of the base currency. This one lot size is also referred to as a standard lot. There's a couple of other common lot sizes or contract sizes that are traded within the Forex market. There's 0.1 lot, which equals 10,000 units of the base currency, and this is known as a mini lot, and also 0.01 of a lot, or 1,000 units of the base currency, and this is referred to often as a micro lot. So let's break down lots to a dollar value to further understand them. If we're trading the Great British Pound versus the US dollar, one lot would equal 100,000 Great British Pounds. This would mean that if we were to buy one lot of Great British Pound versus US dollar and the price was currently 1.46327, we would need 146,327 US dollars in our trading account. So let's now take a look at leverage and what it is and how it can help us gain access to being able to trade potentially one lot of Great British Pound US dollar within our trading account. So without leverage, one lot of Great British Pound US dollar would require us to have 146,327 US dollars. 0.1 of a lot would require $14,632 and 0.01 of a lot would require 1,463 US dollars. So that's all quite a lot of money, and not everyone's going to have access to that amount of money within their trading account. So let's see how leverage can help us to gain access to potentially trading those contract sizes within the Forex markets. Pepperstone has leverage levels available from 1-to-1 all the way up to 500-to-1. So let's take a look at a 100-to-1 leverage example and see how that can help us to gain access to being able to trade that one lot of Great British Pound US dollar with potentially less money in our account. So here we can see that we'd need that 146,327 US dollars. By using leverage as a tool at 100-to-1, this will mean that we are able to get 99% of the exposure from the broker, and we will provide 1% of the exposure ourselves, or $1,463. And this will let us trade one lot of Great British Pound US dollar at the price we previously stated. So let's now just take a quick look at 200-to-1 leverage and see how it differs as leverage goes up. So again, we're still trading that one lot of Great British Pound US dollar at that previous price. But this time, because we're using 200-to-1 leverage, we're gaining exposure from the broker at 99.5%, and we're providing only 0.5% of the money, or $732. So you can see how leverage can be used as a great tool to help us to gain exposure to a larger contract size with less money in our account. And the higher the leverage, obviously, the more exposure that we're able to get within our account. So now I'd like to take a look at how we can potentially manage risk within our Forex trading accounts while using leverage as the tool to help us as traders. Firstly though, I'd like to take a look at quote currencies and what they mean in the Forex market. As we saw in our previous example, the Great British Pound versus US dollar, the first currency pair was known as the base currency. The second currency pair, or the US dollar in this case, is known as the quote currency. If we were trading the Australian versus the US dollar would again be the quote currency. And if we were trading the Great British Pound versus the Australian dollar would be the quote currency. Sometimes you'll hear the quote currency referred to as the secondary currency or the counter currency. Now that we've established what the quote currency is, if we were trading one lot of Great British Pound versus the Australian dollar, and we were trading an Australian dollar based trading account, 100 pips would equal $1,000. This is because that when we trade one lot of Great British Pound versus Australian dollar, the quote currency is the currency that we always see our profit or loss converted into. And in this case, we have the Australian dollar as the quote currency, and our trading account would be in Australian dollars. If we were trading 0.1 lot of that same currency, 100 pips would equal $100. And if we were trading 0.01 of a lot of that same currency, 100 pips would equal $10. It's important to keep in mind that if we're trading a currency that is different to our account balance, such as the euro versus Great British Pound, the Great British Pound would be the quote currency, and therefore our profit or loss would be realised in Great British Pounds. Depending on the exchange rate for that day, this can differ the amount that we make or lose in our accounts. So as we saw, if we're trading one lot, that equals approximately $10 per 1 pip. So if we want to risk $100 on our trade, we could do that with one lot and placing our stop loss at 10 pips behind our order. If we were trading a 0.1 lot, $100 risk would equal 100 pips. And if we were trading 0.01 of a lot, $100 risk would equal 1,000 pips. This means that our risk is in our control, and therefore when we figure out what stop loss our trade needs, we can change our lot size to accommodate our risk. So if we want to risk $100 per trade and our stop loss must be 100 pips we feel for this trade, we can put a 0.1 lot in. Alternatively, if our stop loss only needs to be 10 pips, we can use one lot. And remember, contract sizes can be fractions. So if we want to trade 0.25 of a contract size within the Pepperstone platforms, we can do so. So now I'd like to take a look at the idea that higher leverage always equals higher risk. As we saw before, one lot of Great British Pound versus the US dollar would generally require us to have 146,327 US dollars in our trading account at that previous price. Now, as we've discussed, by using leverage as a tool, we can gain access to being able to trade contract sizes like this within the Pepperstone platforms. As you can probably see in the last two examples, there's also ways of us placing stop losses on our trades to therefore limit our risks to the market while trading these larger contracts. We always suggest that you use a contract calculator whenever necessary to figure out the lot size that you should be trading with the risk amount that you'd like to place in your account. And potentially you can also take a look at the Pepperstone Smarter Trading tools to help you with this. We hope you found this video informative, and we'll see you in the next video.